And what is up, everyone? Andrew here, and welcome back to the channel. I know it's been a really long time since I've made a video, but I'm just going to be easing back into things right now. I don't really have an excuse to why I haven't made a video in almost 3 months now, but I hope you guys are happy to see me back, and I am happy to be back as well. So let's just hop right into things right here. So I did not want to put off making a video for any longer, so this is going to be by no means very clean. I just want to get some of my very preliminary thoughts out there right now. Just look at some quick fundamentals of a few stocks, and I will be doing more detailed analysis and DD for a lot of these stocks right here, so do stay tuned for those. So what I'm going to do is I'm just going to highlight my current top pick from a few different sectors. And the first sector we're going to be looking at is tech slash FANG, and my pick out of the FANG stocks right now is going to be Facebook. And I am a very value driven investor. I like to buy my stocks after they've taken a beating, and a lot of times that can result in buying a dip. For example, if you bought here or here at 170, right now Facebook is sitting, it closed at 159.33 today, and yeah, you would be down, but the general idea is that you buy when it's down and you hold. You either just hold or you hold until it's back up to a point. For example, if you bought here, you could have sold anywhere along here and made profit. So after hitting a high of nearly $220, Facebook is now sitting at just under 160. I think that's almost a 30% drop from its high. So that is pretty sizable. And we can see that Facebook was one of the it wasn't extremely expensive. However, it was by no means a very cheaply valued stock in terms of tech and FANG. But now we can see that after dropping quite a lot, Facebook is now valued quite fairly. PE ratio here of 22 and a forward PE of 19 and a price to earnings growth of under 1. So these are some pretty impressive stats. And I'm going to compare it to Apple here, which has been quite undervalued for a long time. Back in the first half of 2018, and Apple was quite undervalued compared to what is sitting at now. I remember making a video back around this time, I believe, on why Apple is a very solid investment that you should consider. And because for such a huge company in tech, it was just too cheap. I believe Apple had something like a 13 PE and a forward PE of like 11 or something around this time. So we can see that after this huge run up now, Apple's valuations are sitting very closely more in line with Facebook now. And not to say that Apple is now overvalued or anything. I think Apple is still very fairly valued right now. You're just not getting a steal like you were here in February or May or even in June. But going back to Facebook here, we can see that overall they just have great numbers. And even after all that has happened to Facebook, I believe that they are still going to be raking in a ton of money, and I don't think that their platforms are going to go anywhere anytime soon. And on the contrary, even, they're going to experience massive revenue growth once they start monetizing Instagram and WhatsApp even more than they already have. So next up in the popular American media slash entertainment category, my pick is Disney. And we can see that Disney right here, this is a pretty hard chart to really get a good look at how things are going, I believe. So we're going to zoom out. This is a 10-year chart almost. And we can see that from 2011 to 2015, Disney had a nice solid run up. And then now it has traded sideways for a while. This is the run up. This is the consolidation phase. And yes, this is an extremely long-term chart. So Disney is usually a pretty slow mover. They're not extremely volatile. You see, like it's been almost 4 years now, and they've traded between $90 and $120. So nothing super crazy volatile with Disney, but they are sitting up here with a possibility of breaking through. And even if they do come back down, I would definitely buy more of Disney. I do hold some of Disney right now in my portfolio. But overall, what I'm seeing on this long-term chart is a run-up, a nice consolidation phase, and more of a run-up possible. And I do like everything that Disney has to offer. They're fairly valued at a PE of 17. So none of these numbers are extremely good by any means, but they're all solid numbers to have, especially in today's market when a lot of stocks, I would argue, are on the more overvalued side. So relatively, I would say that Disney is one of the better picks in terms of value, actually. Also, there's been a lot of talks about how they can steal a lot of Netflix's market share with a streaming service, streaming platform that is in the works, and I think that would be a great success as well for Disney. So, onto my financial sector pick. It's going to be Bank of America. And this was really hard to pick because I do like JP Morgan and Jamie Dimon a lot. So I would definitely not blame you for picking JPM over Bank of America. I think they're both solid picks for the financial industry. And I also have a soft spot for Ally Bank because I love using their online savings accounts. So I would love to invest in them too. But just looking at some of the numbers and valuations, I think Bank of America marginally wins as the best pick as of right now. So let's go into some of their numbers. Their PE of 13.95, forward PE of 10.19. These are very fair valuations. They've traded sideways for a while now. They're a couple percent off their highs, maybe, I don't know, 5 to 8% off their highs here. And we can see that I love Bank of America's numbers. Price to free cash flow is very good. Price to cash is very good. They're hoarding cash. For all these solid established banks, they still have really good price to earnings growth, which is nice as well. And on top of that, they have a 2.03% dividend yield right now. So overall, all great things from Bank of America. Just also, they're not extremely volatile. Let's zoom out just a little bit here onto the weekly candlestick chart. We can see that for the most part, they're not extremely volatile, and they've had a very, very big run up in the last 2 years though. So if you're scared of that, maybe hold off. But what I'm seeing here is uptrend, consolidation, uptrend, consolidation, and I think that this, I don't know how much longer this may consolidate, but I do definitely see this $28 mark right here being a very, very strong support. We can see that this is where we sort of went up and then we hit the support down here back in January. So I would say $28 as a very strong support does make me want to invest, as the downside is very limited. Overall, a very comfortable investment. And if you don't have any financials in your portfolio right now, why not? Next up is Micron. And how could I not mention Micron? Micron is one of my favorite companies, and the stock is basically a meme at this point due to their huge volatility. And Micron is one of these companies that common retail investors seem to love and not understand the hate that it is getting from some of the more institutional investors. And there's a lot of different reasons why Micron's valuations are so cheap, and it is something that I'll go into more if requested, but I have spoken about Micron a lot of times already previously on this channel, so go check out those videos as well. But with their most recent earnings call is what I wanted to talk about, because they reported great numbers for the quarter. Sure, the guidance was not as good as it could have been, but the guidance was good enough to the point where the bear case honestly should not be considered as much anymore, in my opinion. Overall, I think when you combine Micron with their buybacks in plan, with how DRAM and storage is getting only more and more in demand as we shift towards smart tech and AI, that's going to use up huge amounts of memory. One thing that people point to for Micron is the cyclicity of how memory prices are cyclical, and yes, that has been true in the past, but now compared to the last cycle and even the previous cycles, there are less players in the memory area. I believe last time there was about like maybe 12 to 20 companies really doing memory, and now there's only the 3 big players, which are Micron, SK Hynix, and Samsung, and Micron is the only American one for that matter. And then you have things like the tariff war in China, and while that I understand will affect some of their revenues, overall, given how the stock market for so many stocks and how it should be is a valuation based on future prospects, I feel like Micron is not really getting the same love in terms of their future prospects. Yes, we may see just a more flatter EPS for the next 1, 2, even 3 years, But in terms of future prospects, Micron, I believe, is going to have an extremely bright one. And if you like value investing, if you like seeing a PEG of 0.19 here and a PE ratio of 4.6, by all means, if you have the time frame to invest in Micron for the very long term, I do believe that long-term holders of Micron will be handsomely rewarded. Overall, all their numbers look great. The company itself and the industry that they're in is only going to get better from here. And that's all I have to say about Micron. And lastly, moving on to a dividend blue chip food player here, we have McDonald's, another dividend stock that I do enjoy. So yeah, getting started here, their valuation here is fair. Price to earnings growth is a bit high, which just means that McDonald's isn't expecting large growth in the near future. But one thing that I really liked and one thing that sent them up from, I believe, from the 158 on this big day, 160 to 165 here, we can see that they went up a lot, gapped up over here, is when they announced quite the dividend hike, a larger one than people were expecting. And I do believe that McDonald's shift to a more very established dividend royalty will definitely help its stock. And McDonald's is a good stock to hold if you are looking for something that has dividends. Overall, their numbers are okay, could be better, so definitely on dips if you want. But long term, McDonald's ain't going anywhere. If you've been to one recently, you'll see that they're nice and sleek now. They got all those mobile orders. They got the touchpad ordering. They've even made announcements as to having their food being sourced more healthily. And I'm sure, however true that is, will attract some more customers as well. So overall, guys, thank you for getting this far if you have. I will be making more videos really soon. It is sort of difficult sometimes to talk about stocks if I've already talked about them in the past. I don't want to be really repetitive with anything. So thank you all so much for watching. I will have a new video out soon after this one, and I'll see you guys in that one.